There is only one other metal this year that has performed like silver, and that is platinum. And let me tell you, this might just be the beginning for this metal. Today, we're diving into why platinum could actually surpass gold. Yes, potentially outshine it, and what that means for investors and traders watching closely. We're not talking hypotheticals lightly tossed around. We're talking concrete performance, historical context, and real market dynamics. Platinum isn't just another shiny metal. It has a history of commanding prices above gold, giving rise to the term platinum standard. That's not marketing fluff. That's decades of market recognition, industrial demand, and scarcity baked into its value. It's the standard above the standard for a reason. Now let's not get lost in the surface level arguments. Yes, platinum has a reputation. Yes, it's historically traded above gold. But what really matters is what's happening now. And here's the kicker. Yesterday, platinum surged more than 7.5% in a single session, climbing to $2,133 an ounce. That's a massive move in a tiny volatile market. Volatility, by the way, is not just a footnote here, it's a feature. It's what makes platinum exciting, but also what makes it risky. For those who've been following precious metals closely, you know I've been bullish on platinum for years, and this year has validated much of that stance. But I'll be brutally honest. This is not a safe bet in the same league as gold or silver. It's a fringe, industrial-focused metal that can swing wildly, and that's part of the story you're not hearing everywhere else. Platinum's story isn't just about spikes in price. Its rarity is staggering, about 15 times scarcer than gold. And most of it comes from just two regions, South Africa and Siberia. Political instability, war, supply disruptions, these aren't minor risks. They're major catalysts that can accelerate price moves dramatically. Add industrial demand for automotive, green tech, and jewelry, combined with macroeconomic factors like inflation, quantitative easing, and liquidity injections, and you have a perfect storm for rapid gains. That's exactly what we've been seeing. Platinum is reacting to the same forces driving silver and gold, but because the market is so small, the moves are amplified. Historically, platinum has only occasionally been used in transactions, Russia's brief experiment during a financial crisis being the most notable. But that's not the point here. The point is that it behaves differently than traditional safe haven metals. Its price is sensitive to both industrial demand and macroeconomic shifts, which makes it a hybrid asset in many ways. Part hedge, part industrial bet, part speculative opportunity. And right now, those dynamics are converging. China is increasingly buying platinum for industrial and investment purposes. The US Fed is signaling potential easing, which boosts liquidity, and geopolitical tensions keep the market on edge. Every factor is aligned for upward pressure, and the tiny supply just magnifies it. Here's the part most people miss. Platinum isn't just climbing, it's narrowing the gap with gold. The gold to platinum ratio is around 2.09 now. Not long ago, it was closer to 3 to 1. That's a dramatic tightening, reminiscent of the silver to gold ratio shifts we've seen in 2025. The implications are huge. If this momentum continues and volatility stays high, we could see platinum challenge gold in nominal terms within the next year or two. I'm not predicting it. I'm outlining a trajectory supported by supply constraints, industrial demand, and macro catalysts. But here's the cliffhanger. You won't believe how close platinum already is to hitting a nominal record high, and what that could mean for investors who understand these market dynamics. To understand why platinum could be on the verge of something historic, you have to look beyond just yesterday's price spike. This is about a confluence of macroeconomic forces, industrial demand, and supply limitations that few other metals experience. Platinum isn't just moving because traders are chasing momentum. It's moving because the fundamentals are tightening, and the market is incredibly thin. South Africa and Russia dominate global production, and neither region is politically stable. Any disruption there, labor strikes, regulatory changes, or geopolitical conflicts, translates directly into higher prices. That's why a 7.5% move in a single day isn't shocking. In a market this small, it's inevitable once these forces align. Let's talk macro for a moment. Inflation is no longer just a number reported by governments. It's a reality affecting purchasing power globally. Central banks, especially the Fed, are signaling potential rate cuts, and quantitative easing could return to inject liquidity into markets. More liquidity doesn't just inflate stock prices. It pushes investors toward real tangible assets like precious metals. Platinum benefits disproportionately because its industrial demand amplifies price sensitivity to macroeconomic shifts. Unlike gold, which is primarily a store of value, platinum is actively used in catalytic converters, fuel cells, electronics, and green technologies. That dual demand, from industry and investment, creates a scenario where price moves aren't just speculative. They're supported by real-world consumption. Now think about the institutional angle. Most hedge funds, commodity ETFs, and major investors have historically ignored platinum in favor of gold or silver. That's starting to change. When large players enter a market, this thin, even modest buying can push prices significantly higher. This isn't theory. It's what we've seen with silver this year. Institutions chasing performance are now circling platinum, and the metal's tiny size makes it far more sensitive to capital flows. One large allocation can move the market multiple percentage points overnight. That's why yesterday's 7.5% surge matters. It's signaling that these players are already beginning to engage. On the global stage, China is quietly emerging as a major driver. Industrial demand is surging, not just for catalytic converters, but also for investment products like coins and bars. Unlike India, where gold dominates, China is increasingly diversifying into platinum, viewing it as both a safe haven and a strategic industrial asset. That could translate into a 50% year-over-year increase in demand just from Chinese investors. Combine that with European green tech initiatives and automotive electrification programs, and you're looking at a demand trajectory that dwarfs anything we've seen in platinum's history. Here's the nuance most analysts miss. Platinum's price isn't just volatile. It's incredibly responsive to sentiment shifts in macro and industrial cycles. During the 2008 financial crisis, platinum surged faster than gold or silver, driven by fear of supply shortages and industrial demand disruption. Today, we're seeing echoes of that same dynamic: supply constraints, geopolitical instability, and expectations of easier monetary policy. But unlike 2008, we also have structural demand growth from emerging green technologies and industrial modernization. The stage is set for potentially outsized moves that many investors aren't even considering yet. And here's the kicker. This convergence of industrial, macro, and institutional factors doesn't happen often. Silver had its rally in 2025, but platinum is even smaller, rarer, and more sensitive. That means the potential for explosive moves is magnified. The metal is quietly positioning itself for a historic trajectory, and yet very few traders or investors are paying attention. If you connect the dots, tiny market, industrial demand, macro liquidity, geopolitical risk, and rising institutional interest, it's clear why yesterday's price action wasn't a fluke. It's a signal. Now that we've covered why platinum is positioned for significant moves, let's get into the technicals, the actual price levels and patterns that matter, and what they tell us about potential scenarios. First, look at the recent surge above $2,100 an ounce. That's not just a psychological milestone. It's a resistance level that had capped platinum multiple times over the past decade, breaking it with volume signals that demand is strong and supply is constrained. Historically, when platinum has breached key resistance levels, it doesn't just stop there. It tends to accelerate, especially in a market this thin. Yesterday's move is a textbook example. If we zoom out to the broader chart, platinum's trend shows a series of higher highs and higher lows starting in 2020. The 2020 low near $500 to $600 an ounce was followed by a steady rise that accelerated in late 2023 and 2024. We're seeing the same momentum continue in 2025. The moving averages that matter, 50-day, 100-day, and 200-day, are all aligned bullishly. Price is well above these averages, confirming a clear uptrend. Momentum indicators, including RSI and MACD, are not yet in extreme territory. That means, technically, there's still room for platinum to climb before hitting overbought levels. Next, consider the gold to platinum ratio, currently about 2.09. That ratio has compressed from 3 to 1 just a year ago. Ratios like this historically signal relative value opportunities. When platinum trades significantly below gold in this context, it's underpriced relative to historical norms, especially given its scarcity and industrial demand. Traders and hedgers watch this closely because a ratio compression often precedes sharp price convergence. If platinum continues to narrow this gap, breaking above gold becomes a realistic scenario, particularly in a market sensitive to macro and industrial catalysts. Let's map out scenarios. On the bullish side, if industrial demand continues to rise, geopolitical tensions persist, and central banks maintain or expand liquidity, platinum could test the nominal record near $2,270 per ounce. Breaching that level would not just be a milestone, it would trigger momentum-driven buying from both retail and institutional participants. A breakout like that could accelerate quickly because of platinum's small market size. On the bearish side, a significant disruption in Chinese or European demand, or a sudden increase in mine production in South Africa or Russia, could temper gains. But even then, platinum's supply constraints make sustained drops unlikely without a global liquidity shock. Volatility will always be present, but the downside is limited relative to the upside, given the metal's scarcity and industrial necessity. Another key technical factor is volume. Unlike gold or silver, platinum's trading volume is far smaller. That means even relatively modest inflows from institutions, hedge funds, or large investors can push the price sharply higher. In essence, the market is highly reactive. Small moves in supply or demand can lead to outsized price swings. Yesterday's 7.5% surge was driven largely by this dynamic. If similar buying patterns continue, we could see repeated daily spikes that compound over weeks or months. Finally, watch the short-term support levels around $2,050 and $2,000. These aren't arbitrary. They represent areas where buyers have consistently stepped in over the past months. As long as these levels hold, the uptrend remains intact. Breaching $2,100 with strong volume was the signal, but holding above $2,050 consolidates the breakout and sets the stage for the next leg up. Stepping back from the day-to-day price swings, it's crucial to look at platinum from a long-term perspective. If you're thinking in months or years rather than hours or days, platinum's story becomes even more compelling. First, compare it to silver and gold. Silver has had its rallies, but its market is far larger and more liquid. Gold, of course, is the ultimate monetary metal, the standard safe haven, and the centerpiece of global reserves. Platinum, in contrast, is smaller, rarer, and more industrially driven. That combination, scarcity plus industrial demand, creates the potential for outsized moves that neither gold nor silver can match in percentage terms. Historically, platinum has demonstrated this behavior repeatedly. During the 2008 financial crisis, it surged faster than gold and silver because investors recognized both its scarcity and its industrial importance. It's a metal that reacts to systemic shocks, inflationary pressures, and supply constraints more dramatically than its larger counterparts. And today, we are in a unique environment. Inflation remains elevated, quantitative easing is re-entering the narrative, and geopolitical risks continue to disrupt supply chains. Those are the same conditions that historically propelled platinum higher. Unlike gold, which is often used purely as a hedge, platinum's dual identity as both an industrial input and a rare metal gives it multiple levers of demand. Long-term cycles are another important factor. Precious metals often follow extended periods of accumulation, followed by explosive upward moves. Platinum's relatively small market size amplifies this effect. What took silver years to accomplish in terms of rallying, platinum can achieve faster and with more volatility. The gold to platinum ratio, currently narrowing toward 2-to-1, is not just a number, it's a signal of value convergence. Over decades, platinum has historically returned to and occasionally surpassed gold, and this cycle suggests we could be entering one of those periods again. Another key point is industrial evolution. Platinum isn't just a metal for jewelry or coins. Its applications in catalytic converters, fuel cells, and green technologies are accelerating. As the world pushes toward electric vehicles and sustainable energy, platinum's industrial relevance is expanding. That means demand isn't speculative, it's structural. Combine structural demand with the geopolitical constraints on supply, and you have a recipe for sustained upward pressure over the long term. Even looking at portfolio strategy, platinum is emerging as a diversification tool that's distinct from silver and gold. While both silver and gold are well-known hedges against fiat currency weakness, platinum adds a layer of industrial exposure. For long-term holders, that could translate into asymmetric returns. Modest allocations to platinum can outperform much larger allocations in gold or silver if the right conditions persist. But, and this is important, volatility remains high. Platinum will not move in a straight line, and risk management is essential. It's a metal that rewards patience and discipline, not speculation. Global demand patterns also support the long-term thesis. China is steadily increasing both industrial and investment purchases, while Europe ramps up green tech initiatives that depend on platinum. Supply constraints in South Africa and Russia continue to create scarcity, and any disruption, political, environmental, or operational, can trigger sharp upward moves. In essence, platinum sits at the intersection of global macro trends, industrial innovation, and precious metal cycles. It's uniquely positioned to outperform, not just on a year-over-year basis, but potentially over multi-year horizons. We've covered the macro context, the technicals, and the long-term implications, and now it's time to pull it all together. Platinum is not just another shiny metal. It's a rare, industrially essential, and increasingly sought-after asset. Its performance in 2025 has been nothing short of historic, with surges like the 7.5% move we saw yesterday, narrowing the gap with gold, and highlighting just how small and reactive this market is. The scarcity factor alone, platinum being roughly 15 times rarer than gold, creates leverage in both price and opportunity. When supply is limited and demand is rising, the potential for explosive moves is real, and history shows that small markets amplify these effects. Here's the key takeaway. Platinum's dual role as an industrial metal and an investment asset is its defining advantage. Industrial demand from automotive manufacturing, green technologies, and electronics isn't speculative. It's structural. Macro forces like inflation, liquidity injections, and quantitative easing enhance investor appetite for tangible assets, while geopolitical and production risks keep the supply side tight. Combine all these factors, and platinum becomes a metal that's set up for continued upward pressure, potentially narrowing the gold to platinum ratio further, and maybe even challenging gold itself over the next year or two. That's not a prediction. It's a scenario based on observable market dynamics. Another insight to keep in mind is volatility. Platinum isn't smooth like gold or silver. It moves in sharp bursts. That's why yesterday's surge matters. It shows how quickly this market reacts to macro news, industrial demand shifts, and capital flows. If you're considering trading or holding platinum, recognize that this volatility is both a risk and an opportunity. Understanding support levels around $2,050 to $2,000, watching resistance near $2,270, and tracking momentum indicators are essential for anyone serious about this metal. Institutional involvement is another critical factor. Hedge funds, commodity ETFs, and large investors have historically ignored platinum, but that is changing. In a market, this small, even modest inflows from these players can trigger outsized price movements. This is why short-term surges are possible, but more importantly, it validates the long-term thesis. Platinum is entering a period where industrial relevance, scarcity, and investor interest converge. The narrative is clear. This is not just a temporary spike. It's part of a broader structural story. Finally, don't overlook global demand dynamics. China's industrial and investment purchases are rising steadily, Europe's green initiatives are driving additional usage, and even minor supply disruptions in South Africa or Russia can ripple through the market. These factors, combined with platinum's small market size and historical precedent, make it one of the most interesting metals to watch for traders and long-term holders alike. Unlike gold, which is well understood, or silver, which is heavily traded, platinum offers a rare combination of scarcity, industrial importance, and momentum-driven opportunity. At the end of the day, whether you trade it or hold it, platinum is demanding your attention. Its movements are a signal that the metals market is evolving, and opportunities are emerging that didn't exist just a few years ago. If you're looking for a diversification play that is small, volatile, and potentially explosive, platinum deserves a place on your radar. As always, this is not financial advice. Do your own research, understand the risks, and never make investment decisions based solely on what you hear here or anywhere else. Precious metals are volatile, markets are unpredictable, and platinum, while rare and potentially rewarding, comes with inherent risk. This analysis is intended to provide insights, context, and ideas, but it is your responsibility to verify, evaluate, and make decisions based on your own due diligence. Platinum could continue to climb, it could correct, or it could move sideways. But understanding the market dynamics gives you an edge in anticipating what might happen.